Hello everyone, warm welcome to Testbook Super Coaching Regulatory Bodies YouTube channel. My name is Madhav Sir. I welcome you all in a very important session where we are going to discuss one of the important financial instrument, and the name of this financial instrument is derivatives. I'm not sure how many of you have heard this term earlier, but today in this particular session I will be discussing with you what are derivatives, how derivatives are used in the secondary market, what is the importance of derivatives, and what are the different types of derivatives. Along with that, we'll discuss where these derivatives are traded. I can assure you, after watching this session, you will be in a situation to understand all the important aspects, all the important concepts related to derivatives. If you check out the RBI Grade B syllabus, in the RBI Grade B finance syllabus, derivatives term is separately mentioned in the finance syllabus, which shows that derivatives are really very important with respect to your RBI examination. I'm just sharing this sessions link with my students. I request you also to do the same so that all the students, they are aware that yes, Madhav Sir is live and today we are going to discuss a term that is derivative. Now, if you remember in the previous session, I have discussed with you a term that is known as financial instrument. Now the question is, what are financial instruments? The financial instruments are the instruments which are used in order to invest your funds or to lend your funds, and against these instruments you earn return. So we can say that these are assets. Along with that, we can also say that these are capital assets which help us to earn profit in the near future. Okay, I guess there was some glitch. Now it's fine. So I was talking about instrument that is financial instrument. We have different types of financial instruments in which we have equity instrument where you invest your funds, then debt instruments with the help of which you provide your funds on loan in order to earn fixed predefined return. Now there is one more instrument, financial instrument, which is a derivative. But what is the meaning of the term derivative? Remember that this financial instrument, which is known as derivative, if someone asks you why it is termed as derivative, because sir, it derives its value. It derives its value. That means derivative do not hold any value of its own. Rather, derivative is just a contract and its value is derived from the underlying asset. I'll take a very simple example with you. Let's suppose I have a phone. Yes, I have a phone and I have iPhone 15 and I want to purchase now iPhone 16. I was very well aware that iPhone 16 is going to be launched, and what I did is I signed an agreement with one of my friend that the day I will purchase iPhone 16, I will be selling you my iPhone 15 on the given price. So actually this instrument which has been signed, and that too on a legal paper where the notary signatory has been done, we both have signed and it has been approved. Now it's a legal paper. It's everything or the entire agreement is written on the stamp paper and with the notary signatory, which makes it a legal paper. Now this is an instrument. We can call it as a financial instrument, but it is deriving its value not from this instrument itself. Unlike share, which has its own value, unlike bond, which has its own value, this financial instrument do not has any value of its own. Its value is derived from its underlying asset. Now let's suppose in that instrument I have written that okay, I will be paying you, or I will be selling my iPhone in 15 to you at 30,000. So what is the value of the derivative? That is 30,000. Actually, that is not the value of derivative. It is the value of the underlying asset for which this derivative has been signed. So this is how we define the word derivative. Let's try to understand the same in much detail. So if someone says what is derivative, so the term derivative is used to refer to the financial instrument which derive their value from some underlying asset. They don't have any value of their own, rather they derive their value. Rather, they derive their value from the underlying asset. Derivatives derive their names from their respective underlying asset. Thus, if the derivative underlying asset is equity, then it will be equity derivative. If underlying asset is debt, then it will be debt derivative. If underlying asset is real estate, then it will be real estate derivative. If it is a mobile phone, then it will be cell phone derivative. I'm just taking an example to make you understand. Got it, guys? Clear? Now, if I restrict myself to the specific assets for which we sign the derivative. So derivative is a financial security with a value which is related to the underlying asset. So we can have a derivative for equity shares, that is stocks. We can sign a derivative for bonds, even for commodities, gold or crude oil. Then we have currency, that is Bitcoin. I'm talking about not only the actual currency, but also for the cryptocurrencies as well. We have derivatives. Then we have interest rate derivatives. We have market indices derivative. For example, I'm signing a derivative on the basis of NSE index, that is Nifty. So on that particular basis, if I'm signing an agreement that I will be paying you this amount if the Nifty crosses this value, that is again a type of derivative itself. Now, the moment we say derivatives, we have different types of derivatives which are available. The first and the foremost is future derivative. Second one we have is forward derivative. Third one is option, and fourth one is swap. I'll start with the first one. What is future derivative? So future derivatives, these are the underlying asset which can be used, or I would say stock, currency, commodity, interest rate can be used as underlying asset. Second, we have forward. So the underlying asset can be stock, currency, commodity, interest rate. So in case of option, so the underlying asset again the same. Swap. So in case of swap, we have only two, currency and interest rate. But the question is, sir, how they are different from each other? What is the difference between all of them? Before we discuss the difference, let's try to understand where these derivatives are available and how come you can involve yourself in the trade of these derivatives. First one, OTC. It stands for over-the-counter derivative. Over-the-counter derivative basically means the derivative in which trade is done between the two parties and all the things such as price of the contract, quantity, the date on which this derivative is going to be mature, that is executed and agreed between the two parties only. So a type of derivative where everything is decided between the two parties. There is no third party involved. What is the benefit? So the benefit is, if no third party is involved, we are open, we are independent to make the transactions. We are open, we are independent to keep up the values, to keep up the transactions, or to keep up the conditions. But there is a negative aspect as well. If no common party is involved, that means no one is going to back you in case of a default. If the second party is not obeying the contract and it is not fulfilling the criteria which is mentioned, then in that particular case, no one is going to help you, no one is going to back you. For example, I have come up with an example. Let's say the price of the gold, let's say example for is a gold. If price become 25,000, then A might not be ready to buy it in 30,000 if they have signed the agreement earlier. So in that particular case, we call it as counterparty risk, where one party do not fulfill the contract obligations. Second, we have exchange traded derivatives. Or exchange traded derivative basically means in order to avoid the risk. I'm not saying in order to avoid the counterparty risk. You may witness the counterparty risk in case of exchange traded derivatives as well. But in order to avoid the risk and in order to involve the third party which will be responsible to pay, or which will be responsible to I would say give you a back, or which will be responsible to compensate your losses in case of counterparty risk. That is the exchange, that is the stock exchange which is involved. So exchange traded derivatives, these are the standard derivatives which are defined by the stock exchange, and their all conditions are defined by the exchanges only. So they are settled through the clearing house. So buyer and seller, they maintain the margin with the clearing house, and with enabled players, one and another will be responsible to make the payment. If one of them do not make the payment, if this particular derivative is declared as under the category of counterparty risk, then the middle party, the exchange, or the third party which is issuing the derivative, which is responsible to finalize all the details, all the conditions, will be responsible to pay on the behalf of the other party. Got it? Now, let's try to understand all of these derivatives one by one. The first one I have is forward. I have an example for you which you can read later on, but now I will be explaining the same example. The example says, let's suppose Rahul has 10 shares of Infosys, and he has received these shares from his father on 25th of December. The price of Infosys share was 2000 rupees as of today. Rahul is worried that the price may come down in near future, so he agrees to sell his Infosys shares on 25th of December future date at a price of 2000 to Shyam. In this, the underlying asset is what? That is shares. So it is known as what? It is known as stock derivative. Now, let's assume what is going to happen. So first of all, these two parties, they have come together and they have signed the agreement. No third party is involved. So it is a direct contact between Ram and Shyam. Future price is pre-decided, and that is 2000 rupees, pre-decided by both the parties. Contract size, that is quantity for which this agreement is signed, that is also predefined, that is 10 shares. And final settlement date or expiry date is also defined, that is 25th of December. I don't know whether you have realized it or not, but what I have done with the help of this example, I have made you some points clear. First one, what is future price? So future price is the price at which the derivative is going to be settled down. What is contract size? So that is the quantity of the asset for which the derivative has been signed. Final settlement date or expiry date, the date on which final settlement is going to be done, or expiry, that means completion of the derivative is going to be done. So there is a counterparty risk that Rahul or Shyam on 25th of December will not sell or buy respectively, because let's say the price increases to 2050 and Ram is greedy. He thinks that if I will be selling it at 2000 to Shyam, I will be losing 500 rupees. Let's not sell it. On the other side, if price drops down to 1950, then Shyam may say that this share is available at 1950 in the market. Why should I pay 2000 for the same? Let's not purchase it. So, but in this particular context, what is involved? Sir, in this particular context, counterparty risk is involved. And these type of derivatives which involve counterparty risk, they are known as forwards, because in case of forward derivative, no third party is involved, and these derivatives they are exposed. These derivatives, they are exposed to counterparty risk. Now, we have certain important terms related to the term forward. First one is spot price. What is spot price? So the price of the asset at the time of signing the agreement. The price of the asset at the time of signing the agreement, that is known as forward. Sorry, that is known as spot price. Second is future price, the price at which derivative is going to be exercised. That means at the time or on the future date which you have prefixed, when you are going to settle down. In that particular case, what is going to be the price on which settlement is going to be done? That is known as future price. Then we have final settlement or expiry date. Final settlement or expiry date basically means the date on which settlement is going to be done. Now, what I mean with the term settlement, try to understand this point. Rahul is ready to sell Infosys shares for 2000 rupees each, and he has 10 shares. On 25th of December, let's say the price is 2050. Price is 2050. So Sham will purchase all these shares for 2000 rupees each. That means he will be paying 20,000, and it's up to Sham now whether he will be keeping those shares with him or he may sell them in the market today, and the moment he will sell them, he will be selling at the current price, that is 2050, and the value is 500. This is going to be what? So this is going to be Sham's profit on 25th of December because he has earned 50 rupees on every share. Now, Ram said, Sham, what you are going to do with these shares? Sham said, sir, I will be purchasing it from you at 2000, selling it in the market at 2050, and I'll earn a profit of 500. Ram came up with the suggestion. Ram said, let's do one thing, Sham. Let's do one thing. I'll not sell these shares to you, and I'll not ask you to pay me 2000 rupees per share. First is, I'm not selling these shares to you. Second is, you will not be paying the funds to me. I'll just pay you 500 rupees in order to settle our transaction. I'll pay you 500 rupees just to settle our transaction because you will first purchase these shares from me. Then you will be selling the same shares in the market and earning 500 rupees. Let's not get into that chaos. Take 500 and let's make cash settlement. So this is known as cash settlement. So in case of forward, cash settlement can be done as well as asset settlement can be done. It depends on the parties. Asset settlement means Ram will pay you or Sham will pay you 2000 and purchase the shares from you. Asset settlement can be done as well as cash settlement can be done. It depends on both the parties, what they want to do. Next, the next point is contract size. Contract size or number of shares in contract. If I say contract size or number of shares in contract, which is also known as lot size, so the size for which the transaction has been done. Next is contract value. If I talk about the contract value, future price into number of shares. Contract value is basically future price into number of shares. So what is contract value? Sir, contract value is the value of contract on which the settlement is going to be done in the near future. In our case, contract value is 2000 into 10, that is 20,000. 2000 rupees is the price, that is future price, and 10 is the lot size. So answer is going to be 20,000. Next is duration. So duration is the time period for which the agreement is signed. So 1 month as it expires within same month. So I would say duration is 1 month as per our example, and this particular derivative is known as what? It is termed as forward contract, or it is known as forward derivative. Moving on to the second derivative. Now, the second derivative we have is future. The second derivative we have is the future. What is future? So future and forward, they are almost same. They are almost same. There is only one difference, and the difference is third party. Third party is involved. So third party, that is the clearing corporation. So what do clearing corporation do? So clearing corporation will be the mediator. Clearing corporation will be the mediator, and this mediator is going to come up. This mediator is going to come up with the agreement settlement. For example, this clearinghouse has issued a derivative to the buyer that yes, if you want, you can purchase Infosys shares for 2000 rupees and the lot size is 10. And this clearinghouse has purchased a future from the seller who said, yes, I will be selling my Infosys shares at 2000 rupees each. And from both of them, this clearinghouse will charge a fixed commission, let's say 1%, 2%, 5%. So in this case, agreement is same, conditions are same, but these conditions are not decided by the two parties. These conditions are decided by the mediator, by the third party. And the third party will become the guarantor. In case of counterparty risk, the third party will pay to the other party. Secondly, in case of future, all the conditions, they are prefixed. All the conditions, they are prefixed lot size, lot price, future price, everything is prefixed and pre-decided by the third party, and once you accept it, then you become the part of this particular future. Once you accept it, then you become the part of this particular future, that is known as future contract. So futures are again derivatives, but they can be termed as exchange traded derivatives, because they are traded with the help of a mediator, they are traded with the help of a clearinghouse. So most of the concept of future and forward are same. The only difference is, in case of future, we have a third party. All these terms are exactly same, but these terms are not decided by the parties themselves. Rather, these terms are decided by the exchange, by the mediator, by the clearinghouse, or the third party, which is going to be responsible to counter, or will be responsible to compensate counterparty risk. That is known as future derivative. Now, after forward and future, we have the next term, that is known as what? So that is known as option and swap, and I will be discussing about option and swap in my next session. So I hope the term future is clear to you, the term forward is clear to you. After that, I have given all the important aspects of future, where I have mentioned how the profit is earned. I have mentioned what is cash settlement, what is physical exercise, or what is physical settlement, that we have already discussed. Then settlement of future, how it is done, I have already discussed it with you. And in the end, I have given you the difference between the two. Is it clear? Okay, so in my next session, that is derivative part 2, I will be moving ahead and I will be talking about options and swap agreements. If you are enjoying this series, you are liking this series, don't forget to like the session, don't forget to share the session with your friends. Do like and share the session with your friends, and do subscribe our channel if you're reaching out for the very first time. Thank you so much. Good luck. We'll catch you soon. Bye bye. God bless you all. Good luck.